Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Frederick, Managing Director of Trading and Derivatives at the Schwab Center, to discuss all the news that's coming out this week and what's a very busy week for the markets. Randy, it's great to see you as always. Welcome back to Trade Talks.
Hi, Jill. It's great to be back with you.
Thank you. And I want to get your reaction to the inflation data this morning. Did the market initially surge more than the Fed thinks it's positive? I think it's a little bit early to say that mission's accomplished for the Fed.
Mission is definitely not accomplished, but what we did get today was an inflation report that tells us that the Fed's actions, hiking rates aggressively for the last 10 months, is actually taking effect, and it is starting to show lower. If you look at the year-over-year data, both PPI, which we got last week, and CPI, which we got today, peaked in June, and they're coming down. If you look at the level of the year-over-year change, the CPI is at a 12-month low and the PPI is at an 18-month low. That doesn't mean inflation's lower. It means the rate that it's increasing has been decreasing steadily. But we're going to get a rate hike tomorrow, 0.5%. That's a virtual certainty. And we're likely to get another one on February the 1st, which right now, that one is still a little bit in flux. What we did see today was the probability of that one being 0.5% fell from about 50% to about 30% or so. But what is important to remember, and I've reminded a lot of people of this, is we're going to get a PCE in about 2 weeks, another CPI, another PPI, and a December labor report. All of those are going to come before the February hike. So there's a lot of possibility for that to change.
Yeah, and guess what? Quad Witch is on Friday as well. So there's another liquidity event that we have to factor in as well. But it's so interesting, Randy. It's not like the economic data calendar changes year to year, right? We
Right.
focus on this each and every year. It's just that the market is really lasered into what's happening with macro right now, because the posture of the Fed and what we're seeing with inflation and liquidity looks very different than it did over the past decade.
It has. I mean, we've been through some pretty unusual times, right? I mean, in the post-COVID era, right after COVID hit in the spring of 2020, we saw the largest fiscal stimulus in the history of the country, where something like 30% of all the money that exists in this country was created in the last 2 years. That's unprecedented. Then we saw now the largest spike in inflation as partly a result of that big fiscal stimulus since we've seen it in the early 1980s. So 40 plus years, this is the highest inflation since then. So these are some really unusual times. So yes, the market is very focused on what's going on. When was the last time we saw mortgage rates double in just 6 months? That just doesn't happen very often. So the Fed was a little bit, well, I would say a lot too slow to start hiking rates to control inflation. Now they have to hike aggressively, and they will hopefully not overshoot and have to cut rates next year. That's what we're hoping doesn't happen. Now they're in the process of sort of tapering back the rate at which they're hiking. I believe, as I said, tomorrow, it's a virtual certainty we're going to get a 0.5 point, which is a relief, I think, after 4 consecutive 3/4 point hikes.
Yeah, well, it's so interesting. It's the rate of the pace and how quick everything is changing, because a lot of people got mortgages 3% and under. Now they're actually getting savings rates that are higher than that. I mean, as far as I know, that anomaly hasn't really existed that I can recall in recent history. So what's your outlook for the remainder of the year? It feels as if these scenarios are either if or until a sustainable trend is established, which feels like second half of 2023.
Yeah, and I've actually been fairly optimistic in the post-midterm election period for a couple of reasons. One, not every single year, but if you look at long-term patterns, the last 4 to 6 weeks of the year are typically a very bullish time for the most part. Doesn't happen every year, as we know. Certainly it did last year, but it was a very bullish year overall. But generally, that tends to be a seasonably annual bullish period of time. The second one, which I think is much more credible and pretty remarkable, really, is what has happened in the post-midterm periods. For midterm elections going back all the way to 1950, the 12-month period following that has been bullish every single time. I mean, every single time. The least amount of gain we've ever seen in a 12-month period. Now, granted, we're only a month and a half past it, but in a 12-month period has been about 6%. The highest has been in the mid 20% range, with an average of around 16%. So my thought was that once we got past the midterms, everyone was very panicked about how important this one was. It didn't even really matter what the outcome was, just that it was over, and now we can stop worrying about it. And as you know, we had a downturn on the day of the midterms, and then the very next day, the market started going up, and it's up about 12% from that period. So that has happened. And my belief is we will probably see continued movement. It won't be robust, but we should finish higher, I think, at the end of the year than where we're at right now. Now, when we get into next year, that's a whole different story. As we know, this year we had a major pivot literally on the second day of the calendar year. There's a possibility that could change, but ultimately I do think it's going to be dependent on economic data. As you know, we're in the middle of an earnings season now, or I should say we're in between earnings seasons right now. We've got about a 2-week period and then another 2-week period before the Q4 earnings start. So it's about 4 weeks. And during this time, I think it's going to be very, very much a news sensitive environment. And that includes economic data.
Yeah. All right. Appreciate the insight as always, Randy. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
You bet.